this is Roger Scott from Market Geeks with the third part of our three-part series about MACD indicators. Before I begin, I'd like to remind you to subscribe to our video channel for swing trading videos and trading tips. And don't forget to visit MarketGeeks.com for your free trading report. The last few days, I focused on demonstrating the different parts of the MACD indicator so that you would become familiar with the MACD and, more importantly, less intimidated when analyzing MACD chart patterns. Most beginners have difficulty learning the MACD because it's made up of several parts that interact with one another. Once you understand how the MACD line is calculated and understand what each of the three parts of the indicator calculate, the indicator becomes very simple to understand and, moreover, to utilize. If you're still having trouble identifying any of the three parts that make up the MACD, I suggest reviewing the last two articles. They can be found on Market Geeks' featured articles section of the website, which is the featured part and the main part of the Market Geeks website. Today, I will show you another way in which traders use the MACD indicator. The method is called divergence. This is by far the easiest way to use the MACD indicator and one I suggest that you start with. The concept of divergence is based on overbought and oversold price levels. Divergence is basically a short-term momentum technique to determine where markets are running out of steam temporarily. This method of analysis relies on visual analysis of the MACD line. That's the line that you see a blue arrow pointing towards in this video. Divergence occurs when the MACD diverges from the price of the underlying market. A bullish divergence forms when a market makes a lower low and the MACD line forms a higher low. Since the MACD line measures momentum, bullish divergence between the market and the MACD line suggests that the market may be moving higher despite of the fact that prices are moving down in the short term. You can see a perfect MACD chart divergence example of this chart of Hyatt Hotel. Notice that the stock begins a strong rally after diverging from the MACD substantially. Keep in mind that divergence analysis works best for reversal formations after markets have been trending for a substantial amount of time. Bearish divergence occurs when markets are making higher highs and the MACD line is making lower highs. This pattern is the exact opposite of the bullish divergence and works well after markets have been trending strongly for an extended period of time. I do not suggest using divergence patterns in range-bound markets. The lack of strong momentum will not produce meaningful results when using the MACD indicator in these type of market conditions. Notice in this particular example how the QQQ diverges after a strong uptrend that lasted over 4 months. You always want to see a strong uptrend prior to using the MACD for divergence. Here's one more example so you can get a good idea of how the MACD chart divergence sets up. Remember, you don't have to pay attention to either the histogram or the signal line when analyzing divergence. In this example, Apple Computers appears to move higher but quickly heads south after a few days after a bearish divergence signal. This setup works well with basic reversal patterns such as double tops and double bottom patterns. I always use the MACD as a confirmation indicator when trading these patterns. In this final example, you can see how Bank of America stock makes a lower low while the MACD is strongly moving higher at the exact same time. Notice it occurs after a strong downtrend as well. The best MACD divergence patterns occur after a prolonged trend and momentum moving in one direction. Divergence analysis is another way to utilize the MACD indicator. Keep in mind that divergence only works after a sustained trend coming to an end and exhibiting strong momentum in one direction. Does not work in range-bound and choppy markets. Also, MACD divergence works well as a confirmation indicator for other reversal patterns such as double tops and double bottoms. Avoid using the MACD divergence when trading range-bound patterns and when markets are just beginning to trend, because the MACD does not work well in those type of market environments. Thanks for joining us for today's trading tutorial. Don't forget to visit MarketGeeks.com for your free swing trading report. And don't forget to subscribe to our video channel for updates and trading tips. Wishing you the best in your trading.